Chris Van Dusen, welcome into the show, brother.
Thanks, man. Appreciate you having me.
So what is Slyco Capital focused on right now with all the craziness going on in the market? I'm sure you're seeing the 2 trillion wiped off the markets today.
Woo.
You know, obviously in times of chaos, there's great opportunities as well. We're seeing a lot of business bankruptcies. We're seeing a lot of new businesses come, out of, early stage entrepreneurs. I know this is a space that you guys play in and are constantly, keeping a pulse on. So what are you seeing and feeling out there right now?
Well, so it's a big question, right? What's happening? Is this early stage recession? Is this just a response to a few things that we saw in the market? You know, as you mentioned, we do a lot of early stage investing, right? So that's seed through B at Slyco. Access to capital has been tough over the last few years. So a lot of these companies are already capitalized in a nice, meaningful way. And so while, yes, the capital markets will impact M&A downstream, it'll impact access to debt capital and others. For our portfolio companies, they're in a spot right now where they have capital. So they just need to continue to execute. And so that's where it's not that this is decoupled, right? Because they absolutely impact each other. But it's not necessarily anything new than what we have seen, whether or not we were coming out of COVID, out of 21 into the last few years of having, capital markets a little topsy-turvy, as well as having cost of capital very expensive. So for us, we're looking to continue to execute our plan. If I dig into Slyco a little bit, we're different than most traditional venture shops, right? We traditionally invest seed through B. But for us, we have 11 senior partners, which I happen to be one of. A few of us do more traditional venture roles, raise capital, find deals, what we call power brokering within our ecosystem of 34 companies. We have this amazing team of partners and leadership and staff that really are going inside of these companies during this period, during this formidable time of growth and helping them scale. Whether or not it's putting operational rigor, or whether or not it's, providing CFO services, accounting services, even growth services in the form of marketing. I was a past chief revenue officer. We'll all go in and help these companies during this period of time. And that's very unique in the venture space. And so for us, we've been in these companies for these years, kind of helping them see past the horizon, setting up things we believe that'll help them for long-term growth. So hopefully in some ways that insulates a lot of what we're seeing for other companies and more traditional venture that may be part of a fund and they're figuring out how to support and what they're going to do if they need new capital during this time where the fund can't support or they don't have access to debt. It's a little bit different because of our strategy.
Yeah, I love how nimble you guys are. And, as you said, right, kind of more of a creative shop that isn't, hey, here's our fastball. This is the only deal we do. If it's not in this box, we don't swing. You guys are more deal makers and creators, right? And trying to find the best fit for creating whatever win-win outcome it is that you guys feel collectively can be achieved between, the groups and the businesses you invest in, achieving your investor capital goals. And I know obviously you guys are playing somewhat both sides of the fence. You've got your kind of investment focus and yields that you need to get for investors and goals that you guys are aiming for. And then obviously you guys are also working very intimately in the operations and with business owners. So maybe we could talk on somewhat of both parallels there for entrepreneurs and people that are early stage business owners and entrepreneurs that are looking to scale. I know you've had 3 exits yourself. What are some of the things that you guys look at or that you've seen from your own experience, other businesses that you guys have invested in, being key foundational pillars for companies when you're analyzing them? You guys decide this is a worthwhile investment. And what are some of those variables that you guys are looking at?
Yeah, no, that's a great question. If I were to take a step back and say, let's look at traditional venture, right? And again, not sitting here on a platform of dogging traditional venture, but there's just these kind of incentives. If you look in your kind of 3 constituents, you have founders, you have the general partners at a venture firm, right? You go raise that capital to deploy in the companies, and then you have the underlying investors. Traditional venture is what they call a 2 in 20 model, meaning 2% management fee on the dollars that come in and 20% promote or carry, which is how the GP makes their money on the investor dollars. And those are deployed into companies. The companies do the right thing, right? Over the next 5, 7, sometimes 10 years, both the founders as well as the investors and the venture partners make money. Traditionally, however, that is, I'm going to go raise a bunch of money. Let's call it a $100 million fund, $250 million fund. And then I'm going to have a thesis. Now, a thesis could be industrial manufacturing, could be AI, which is the fervor today, right?
Yep.
It could be blockchain back in the day. And then I'm going to look over a 12, 18-month period and find companies to deploy against that thesis. And there's nothing wrong with that strategy other than you're now looking and saying, I've built a thesis, I've raised capital, and I need to deploy it in a certain amount of time so that it fits my mandate from a time base. For us, we're a little different. And what I mean by that is we don't really run on a 2 and 20 to start. And secondarily, we will identify companies and then go raise capital for those companies, right? We have an amazing LP base, amazing partners that we work with. We're able to get capital in for these opportunities. Why that is different is there's no time frame that we have to deploy capital.
Yeah.
Right? We'll identify great companies. So to go back to your question, what makes a great company? We invest in people and we invest in platforms and opportunity. And those things can't be decoupled. And why I say that is a big percentage of early stage failures come from partners who don't get along, right? Or have overlapping skill sets and don't know how to separate responsibilities, or don't have any overlapping, but can't figure out how to trust their partner to go do the right thing. So partner dynamics, founder dynamics are extremely important. We look at an executive team and go, do they have the capabilities to see this through? One, do they have the ability to see it through the vision they've purported they can do? Two, do they have the mindset and ability to do what is the entrepreneurial journey? So in a lot of ways, I like finding a second founder, meaning they've already had one exit. They
already got
know
their
what
ass
it's
kicked
like.
a few times.
Yeah. Yeah. They've had doors shut, right?
Yeah.
Because at the end of the day, like, and again, we love to romanticize the entrepreneurial journey, and I love it. By the way, I'm had a few exits. I've done this a few times. What no one talks about is there's a graveyard of companies along the way that I tried to do, right? Luckily, self-funded, so I didn't have investor capital that I had to go answer to. But certainly, I'm not batting 1,000, and most entrepreneurs aren't.
Right.
And so there's this way of, if you've gone full cycle, you've come up, founded, grown, and found and built something and found someone who valued it enough to purchase it from you, you've gone through that entire arc. And that entire arc is extremely challenging.
Yes.
And what people don't realize is they think it's just linear, and it is not. It's all over the place. I think Mark Suster, very prolific investor in LA, had this great chart I think I saw where most people think it's this, and it's really this, hopefully, right within this 5-year period. And it's hard. And so do you have the fortitude, that grit and determination, and can we identify that you have what it takes to see it through? And then we're not in the business of building lifestyle businesses. There's nothing wrong with that. There are great businesses, right? I used to own an ad agency, great business, but it was not something that I had a vision to scale into something, to be the next Publicis, right? Out of France, right? All over the world.
Yep.
And so it was a great lifestyle business. I wasn't taking capital. You may have a great idea for a business, but doesn't have the ability to truly get to a size and scale that our investors can make what they expect as a return. And early stage needs to be looked at a multiple of invested capital. The further you get upstream, the more mature companies get. You can look more at like an IRR or like an internal rate of return on your investment.
Yep.
But really, most early stage investors are taking a larger risk for a much larger reward. So is there an ability within a 5, 7, let's call it with an extension, 10 years, to get you 10, 12x, right, on your money as an investor? And so we're looking there. And then certainly because we're not angel investors, right? We're not at that early idea stage. We want to see traction. We want to see some product market fit. We want to see that we're providing you growth capital, right? You've already identified and kind of removed some of the barriers of risk. And so if you have that, what are those signals, and what are those signals looking like, right? Do you have contracts that are in place? Do you have POs and you just need manufacturing dollars, right? Like, we're coming down to trying to make those determinations of evaluating the true opportunity versus the risk, even at seed A and B stages of the company.
Yeah. Now, I know when you guys are obviously looking at, you said people being a big one, the company itself, the, thesis, the market fit, I'm sure, the revenue and the economic model behind it. Mm-hmm. Talk about the people analysis component and how, being that, as you know, right, I've seen and invested in a lot of actually good businesses and business models, but, while the deal looked good, the people didn't. how do you guys discern and audit the people, the executives, the leadership team, the founders, and what are the differences between the ones that are winners and oftentimes the one that are losers?
Yeah. So it's not a perfect science. We have tools and different things that we're starting to deploy. Think of them as personality profiles down to
Yep.
if you're let's call it someone like who needs to be out in the world to be successful, needs full autonomy, needs all of this, right? Uh, I forget what the actual term was in this system that we use. Trailblazer actually is what it's called. Trailblazer, right? That's great, right? In fact, in this thing called the Culture Index, I would be considered a trailblazer, right? Full autonomy. I like to be out in the world, social, just great because I typically raise capital, find deals, do the things. But if mine came back where I was someone who needed to sit behind a desk all day and just execute and had a big gas tank to do so, and being out socially wore me out, well, then that's probably not the right fit. And so as we're evaluating founders, we'll look and say, hey, are you someone who can have the capacity to do this, is amenable to ideas, amenable to suggestions we may have, or is it your way or the highway? And we'll kind of try to triangulate what their personality mix would be and how they're going to be able to execute against this. I mentioned being amenable. So because we don't have to deploy capital right away, and we're not sitting on this bank of capital where we're going, okay, that's a great idea. We're running up against the clock. I still need to deploy capital. It's in my thesis. Here we go, right? We're going to take a flyer on it because I have portfolio theory in my back pocket, which is essentially I've assumed 40% thereabout of these companies in my fund are going to fail.
Right.
One's going to return hopefully 100% of what I've raised, and the others are going to be singles, doubles, and triples, and I'm going to get a great return for our investors. Since we don't look at it that way, we're making bets on that company being successful and that founder being able to do what they need to do. And so because we're not doing that, we can spend more time up front doing due diligence. And why I say that is we can even what we call leg into deals, where we'll take partner capital and put a small amount in and work with them to establish the KPIs for a larger round later. And so it gives us more flexibility. Again, that creative finance part of it, where we can start to see if they're going to be able to make certain pivots, right? There's a great company we were evaluating, and I thought they were maybe just a degree or two off on strategy. And they took it. We hadn't invested $1, but they said, that's actually really interesting. Let us go work on that. And for the next 30 days, they did. And now that is a key pillar of their strategy, the small move, and they're seeing great results. I've met with individuals who you give them those couple degrees of change, and they say, absolutely not. Thanks for coming. Have a good day. And that's tough when you're saying, well, we're bringing capital to fulfill a vision, and we think your overall vision's right, but how you're going about it's just a smidge wrong. Mm-hmm. What would you think about doing another way? And if you're fully resistant, then that's not necessarily the best partner to have.
Yeah.
And so a lot of it is we have this kind of blessed opportunity to sit and spend a little bit more time as they're raising capital, especially in those seed rounds and early stage, and help give guidance and feel the relationship back and forth before we make larger capital investments.
What is the overall landscape of the market right now that you guys are seeing and feeling? Is there still a lot of dry powder sitting on the sideline looking for opportunistic plays right now with new companies? Are people still being patient to see what happens, in November, or, obviously a lot of global risk that's going on right now? What's kind of the overall feeling from your guys' perspective?
Yeah, I think we came out of a trough, right? 21 valuations were, I would call it, overinflated.
Very frothy.
There was a lot of capital, cheap capital, right?
Yep.
And so traditionally, whether it's capital markets or even in early stage, when capital is cheap, you're going to focus on a growth versus yield model. So think about that as revenue versus profit or EBITDA.
Yep.
And so you're going to see through 21, everything was growth, capital markets and private. As dollars get more expensive, then the focus is less, right? Growth.
Pay me for the risk.
Yield. Yes, more yield. And so I think as we came out of that, companies that had really done a good job of tightening up, possibly reducing, starting to live more on their own cash instead of investor cash, and building towards yield, now are coming out of this screaming. And what I mean by that is, over the last year, I would say capital has been easier to put into companies on an equity or debt basis. Not that interest rates have changed, but the mindset has, coming out of when we saw really high inflationary or interest rates in our environment. What's happened over the last 4 days of the market has caused new issues that people are dealing with from a dry powder perspective. They're saying, okay, well, $2 trillion plus have been removed from my market gains. I might have cash, but I'm unsure what to do. And so for us, we have kind of two ways of looking at it. One, on an equity basis side, making an early stage investment, there isn't yield today. You can look at the companies in our portfolio that we're actively raising for and say, are they a yield-based or growth-based company? Now, I would say the balance is what's most important, especially early stage, because you've got a need to grow because you're in your seed A and B side. Like, that is the formal time to grow, and specifically pre-revenue. So how are you driving towards yield? And then from there, we offer a debt vehicle as well that pays a cash on cash return. And so if you need a place to park cash while you're trying to figure out whether or not it's an early stage investment, or a place before maybe you had great foresight, we're able to put limit orders and get your money out before the big drop, and you're trying to find a place to put your cash until, we have a vehicle for that as well. And so we've been able to move a lot of cash, have cash come in, investments come in, both equity and debt side. And we haven't seen it slow down, even what's happening over the last 5 days. But that's more of a lagging measure, I think, as we're going to see over the next couple months to see how things recover.
Yeah, little bit of musical chairs with the money going on right now.
100%.
Trying to mitigate that risk, still find a way to keep it, as you said, right, moving, because the velocity of money is key, especially in the institutional world. Talk about how you guys are finding capital partners. What kind of dialogue are you having with them? How are you finding deals and companies, and what dialogue are you having with them? What is your kind of lead generation or relationship generation efforts look like, knowing that they are kind of the crux of your business model?
Yeah, so I'll start with the investor side, right? Our traditional investors are high net worth, ultra high net worth, and family office. We do some more institutional, but really the way we've built our deals, built our structures around those kind of cohorts, right?
Yep.
And they have great wealth managers, they have great deals that are always brought to them.
Yep.
We want to be as a place for vetted deals, and a place where they can make small bets, medium-sized bets on these companies or portfolio of companies. And that strategy has worked really well. On the deal sourcing side is different. I'm out in the marketplace quite a lot. I'm looking at what trends are happening. Sure, I wouldn't necessarily call us trend-based investors. We have an AI investment, but the practical use of AI, not a language model. I make the joke, I'm not smart enough to know all of the different places in AI that are going to win over the next 10 years.
Sure.
I don't know what's a feature versus a product. I don't know which language model is going to be the model or models du jour. I don't know what's middleware, right? That's actually going to have a place to live, or it's just middleware and the language model has not gotten there on its product roadmap yet, right? And so for me, I'm looking at it going, well, what's the practical use? We made an investment in a company called AI.io. It is a company that's working on democratizing scouting across the world.
Pretty cool.
They did some really interesting things in India during COVID. You had people submitting videos, doing drills, and I think it was about 17 kids from India were picked to start developmental contracts with some Premier League teams who had never played organized sports before.
That's
so you
cool.
Think about something like that, democratizing scouting,
Yeah,
and then player development for pro teams and others. It's amazing.
That's awesome.
And so when you look at that deal came through something I wrote, reconnected with someone from prep school that I went to in Connecticut, and we hadn't talked in 20 plus years. He introduced me to a friend who's actually involved with the company. I spoke at a conference with them at AI.io. We started understanding the company. Like, it's one of those slow processes to find. I get quite a few inbox related opportunities that I'll review, but most of them I want through those sponsor individuals to find. And that's really where a lot of our deal flow comes from, is through our LP network, through our own individual networks that we'll go and start evaluating. But it traditionally has someone who goes, hey, you need to take a look,
Yeah.
right? Instead of, hey, I'm the founder of so-and-so. Would you take a look? It's a
Right.
very different process.
It is. I agree. I mean, I get so many people in my inbox, whether it's to come on the podcast, whether it's to, have me invest in one of their deals or in one of their businesses, right? And you get that a lot, but it's different when it comes, Chris hits me up and says, "Hey, I got a company or a founder that I think you should connect with, or that I think you should look at." That holds a little bit of different weight because of the relational currency that, you and I might have, right? So I think going back to that, the relationship is the underbelly in this world of finance, investing, deals, business. While you can lead generate your way into maybe some cold conversations or opportunities, it's always going to be the long-term relationship building. I call it the crock pot versus the microwave mindset when it comes to just creating those kind of alliances that over time start to unfold and doors start to get opened and conversations start to, come to fruition, where that's how you find those great opportunities, right?
Traditionally people invest, people do business with, people spend time with. I call it haircuts they like, right? They might be saying the same thing, two different haircuts. They're going to choose a specific haircut. It does come down to the person. It comes down to, is the person sitting in front of you, whether or not it's pitching a deal, whether or not it's pitching investment, whether or not it's discussing an opportunity, discussing a partnership, like, do you want to do business with them? And do you trust them, right? With capital, with opportunity, with business. And so the more you can spend time with people, the more you can be out there sharing your story and what makes you uniquely you, the more people that'll resonate with, hopefully, right?
Yeah.
And then the more opportunities come through, right?
Yeah.
But yeah, I mean, it's tough because it's like, well, I have a startup. How do I go make these relationships? Or, well, I don't have them yet. How do I do this? Well, also I need to go get my capital. So I'm truly understand that. And in the same way, as someone who has raised capital for my own deals, it is tough and you're going to hear no a lot. And that should not discourage you. It should make you stronger and fortify you to go even further.
I was going to say, I mean, if anything, that's part of the process, right? Like, a lot of different messages from Gary Vee, but one that I always love from him is always, you got to trust in the process. And the process is going to include a lot of pain on that path, a lot of no's, a lot of failure. And those are ultimately going to be the things, those are the checkpoints as a founder, as a business owner, as an investor. You have to figure out how to pass those over and over and over again to eventually get to a place where you're actually in a position where you're like, man, this was all worth it. Most people quit well before they get there, as you know. So what is your advice to those early founders? What are some of the things that if you were to tell them, hey, before you go and raise capital, or before you go and take on investors, or before you go and do these things, get these foundational pillars in your business shored up first, then come have a chat with us?
Yeah. So there'd be a couple things. One, for us, we're not idea investors, right? We like seeing traction. So mature companies will have something called a data room, right? It's everything from the cap table to their forecast to POs that they have with clients. That gives a big snapshot. So if you're doing a seed round, you may not be necessarily in revenue, certainly not in profit that early, most likely.
Yep.
But I'm sure you have data on why you believe this is the next huge thing, right? Where does that data come from? Is it you've done surveys, you've done tests, you've got product market fit because you have a contract? Like, start putting together the story. There was a great podcast that I did listen to, and I feel awful I can't give credit here, but essentially it was the best founders are the best storytellers, right? If you just go and start going through this disjointed presentation about why this is going to be interesting, right? It might be interesting, but I'm trying to follow along because I need to tell stories because I need to raise you capital, right? Yep. Tell me the story. And there was a great GP at Benchmark who talked about, if you had a sailboat company, most founders want to talk about the riggings, they want to talk about the beams, they want to talk about the sail, they want to talk about how many labs it might have, what the galley looks like. Fine. In this world, sell me the wind. Because if you sell me just the boat, I don't know if it has any traction to go anywhere.
Right.
It's going to be sitting there in the bay or in the harbor. Sell me the win. Why is your interesting company situated correctly to take advantage of what's happening in the outside marketplace? Because if the marketplace is large enough, the demand is large enough, every boat will take off, regardless of the quality. And why is yours uniquely positioned to capitalize on it? That's the story, right? Because ultimately, that's what will get covered in the press. That will get more eyeballs. That will get everything, is being a great storyteller. And as a founder, in my opinion, whether or not you're raising capital today, whether or not you need to in 3 months, whether or not you've just finished a round and don't anticipate needing money for 18 more months or 2 years, you're always raising capital as a founder, and especially as a CEO. And so you're continuing to take investment meetings with a closed round to say, I wanted to give you an update on where we're at. Yeah, you might have missed it or you didn't have access to it. That's okay. We're going to have another one coming up in 18 months, and I'd love the opportunity to keep you up to speed. Right? Because ultimately, if you're constantly raising money for things that are happening in the future, you're never sitting there going, I have 3 months of burn left and I need to get capital in, which means I'm also going to try to take a down round if I can't get it quick enough, or maybe I haven't achieved all the things I wanted, right? All these things impact. And there's a lot of companies that don't get access to capital at pivotal times because they finished the round, went to executing, came up for air, realized they have 3 months left, 6 months left, go and put together a round. They're trying to go back in a postmortem and see all the things that they've done to justify new valuations and all these things. And they're still burning this entire time.
Yeah.
And so it's one of those, always as the leader, having a mindset towards what the next capital move is going to be is extremely important.
Yeah.
And next is understanding not to bite off the entire market. And I think this is something that I felt guilty of it when I was doing companies, which is my product, service, whatever it is. Sure, we started here, but it can do all these other things.
Right.
So I've got money now. I'm going to build teams to do all these other things. And so the discussion is, what's more important, right? To be a mile wide and inch deep, or be an inch wide and a mile deep within a vertical? Because as you're going, if you can prove that you can own a specific industry, space, vertical, you can then go raise capital and understand how to build teams, but also have done the diligence to know, especially in certain verticals, whether or not it's a SaaS product and you're going from X industry to healthcare or to government or whatever, those can be long buying cycles with incumbents that have long-term contracts. Mm-hmm. And so while you might have a better product, service, whatever, it might be 2.5, 3 years before you ever actually see meaningful revenue because you have to do all this work. Yep. Well, is that the right time to do it when you just raised some opco capital to scale, right, in a seed round? Or is that better suited for proving how deep you can get in one vertical and what it looks like, and then being able to go to someone like me and say, we want to do these two. We've done the analysis. This is how long it's going to take. So we need capital to do the same thing we did here, here, and here. And that is a much more prudent strategy. Now, is it as fun necessarily? No, because you're like, my product can do all this, right? I'll just need to hire the people and the sales team and the engineering to go build their use cases, and then we're off to the races and we could be huge. Yeah, but what's the opportunity cost? What's the institutional knowledge gain that is needed in each vertical that you don't have right now? And that's the weighing that needs to happen. Yeah. And so it's really, again, to kind of sum up, always be raising capital, focus on not your minimum viable product, but certainly minimum viable opportunities with an eye to what could be coming next and what it would take to get there, but really execute on your current plan. Don't get too big, too quick, and too spread out against what you're trying to grow.
Now, before we move on from kind of the capital discussion, you said something earlier that I think is important for people to hear, which is, let's just say not all capital is created equal. Yeah. And there's, in your opinion, a difference between capital and smart capital. What did you mean by that?
Yeah. So let's look at it two ways. You're a founder. You need, let's call it $2 million in a seed round. You can just go out and raise capital. You're getting checks from people, 100 grand, 200 grand, $500,000, whatever, and it comes in. And now you and your team are looking at each other going, we are fully capitalized. Okay, now we need to go. And you're like, man, it'd be awesome if we knew someone in this area of the country or associated with this company or can make an intro here. The problem is if you just raise capital and don't know what those individuals can participate, what they can do to be accretive to the business, then you don't know how to go get necessarily all of those asks done. Then there's smart capital, which is, look, yeah, we're going to take money from them, but they also are involved with these portfolio companies in these industries, or they have relationships. Or for me, I sold a couple consumer product businesses. So I know agencies all over the country can help scale and have relationships with, big grocery stores and big, big boxes. That might be of value, right? I have different relationships in sports through some of my LPs and through friends. If we're doing a sports deal, that would be good knowledge to have because I might be able to open doors, right? And you look across my other 10 partners, they have totally different relationships, totally different knowledge bases and past experiences they can bring to bear. And that's what you mean by smart capital. You're getting the same total of capital, but the attention and the ecosystem and the relationships may be totally different than just getting your neighbor to write you a check for the same amount.
Yeah. 100%.
And that's really what it comes down to is, are you getting someone who may sit on your board, check in quarterly, call you to find out updates so they can merchandise to their LP and their fund? Or are they actually going to do some work?
Yeah.
And that's the big difference.
100%. I mean, it's that strategic capital, right? That you're talking about where, hey, capital is just one box. But if you can say, hey, I get 30 years of relationships, I get this guy's wisdom, experience, mentorship, I get access to their distribution, whatever it is, right? Like you said, it goes beyond, there's layers to the value that's brought on by the capital, not just filling, some commas and zeros in the bank account, but it goes beyond that.
100%.
Now, I know you guys as investors, as business owners, you're into metrics, KPIs, data. What data do you track? Why do you track it? And how are you kind of keeping a pulse in your industry, your market, your investments?
Yeah, from an investment level, it all depends on the type of company, right? So we're going to look at closed contracts. We're going to look at incremental revenue growth, certainly yield if they're later stage. We're going to look at POs, right? What's coming in. We want to look at burn. We want to look at opportunity cost of not doing certain things within the business and what that would look at. From a growth versus, here's a key hire. Yeah, that throws our burn out of whack, but that key hire might be able to bring this revenue quotient over a 12-month period, which gets us back where we need. Like you're making these type of decisions, helping from a management perspective of cash flow. From an industry related side, it is good to see where capital is going, right? Infrastructure plays are certainly a big one now. AI, as I mentioned, is a huge one. So understanding the trends, what's in vogue, what's coming up from an overall M&A activity. Also, from a capital market side, looking and saying, well, the last 2 years have been kind of soft from an M&A perspective, right?
Yep.
And some of that's capital markets driven, some of it's access to capital driven, meaning the cost to acquire. Certainly in the capital markets, if you have valuations down, the stock price is more expensive, meaning they have to use more shares to buy you. And access to inexpensive debt in the capital markets is low or not at all, right? Because everything's expensive. So it's really hard to do M&A activity at a public level. And if you're looking at private equity, what are they going to give you at comps from a value perspective? So we're looking at that. And especially when we're making decisions to invest or do follow-on capital, it's how long until your company, industry, vertical are going to be in the right spot from an M&A activity, right? If you're selling to, say, pharma or biotech, maybe they're less market correlated, or the government. But if you're selling to a specific strategic and that's your goal, and they are 25% off of their, normal market cap, it's probably going to be a while before they're ready to do M&A activity meaningfully. And so that's what we're also looking at, is how the macro environment impact our investments over what we believe is the time threshold we should have them.
Makes sense. Now, for whether it's early stage founders and people that are looking to raise capital for their business, or it's an investor that's, going, hey, I don't really have a relationship that allows me to invest in these types of companies, and I'd like to learn more. What are the types of companies you suggest reach out to, or founders you suggest reach out to, and what kind of investors do you suggest are good fits for, Slyco Capital?
Sure. From a portfolio company perspective, from an investment perspective, we're pretty open. Seed through B is what we want to look at. You can take a look on our website, Slyco Capital, and see the type of investments we do. I call us ecosystem investors. What I like to do is find a company that I know if we brought into the fold, they may have product service offering that could help within our portfolio, or vice versa. There are companies in our portfolio we know could be customers, clients, or have partnerships, right, with this new company. So that's one. Take a look there. Two is in that seed through B round, right? I won't give you a specific on valuation, but traditionally in the 10 to 35 million range is what we're going to look at, right? On the seed and A, and it can creep up there a little higher on Bs, but the quantum of companies that sell for a 10x multiple at $100 million to $150 million range are a lot less than ones in the 20 to 25 range if you were to look statistically. And so for us, again, looking at it as a pure play kind of multiple on invested capital, we need to see those valuations be a little bit lower, not because we're trying to take food out of anyone's mouth, right? We're very investor or founder friendly. It's more, we want to be there on that early stage run with you to help you get it to be a $150, $200 million company.
Yeah.
So range is important. And then we are industry agnostic. We have biotech, fintech, property tech. We do have AI, as I mentioned. We do a couple different investments in sports. We have an infrastructure play and a pallet company and EV chargers. We have wireless charging. We have a bunch of different companies in different verticals, but all have that amazing opportunity to be large platforms. So we're really agnostic. But yeah, we'd love to take a look at what's out there.
Cool.
Number two, from an investor perspective, all of our deals on the equity side are at minimum accredited and a lot of times qualified, which means there are certain net worth requirements to be an investor. And so meeting one of those from an accredited or qualified perspective would be step one. Step two, that traditionally means, again, high net worth, ultra high net worth, and family office are really where the bulk of our capital come from. And, they're making investments in a wide range of total dollars into these companies. And it's really for people who want exposure to world-class companies that have the potential to get good returns. And again, if you were to look at your portfolio as an investor, depending on who your financial planner is, private equity or illiquid investments, alternatives as a bucket is a small portion of your overall kind of net worth that you're playing with on investor side. Traditionally, it's 5% of that 20% bucket. So that's small, right?
Yeah.
And so the idea being, with that small amount, do you have enough, if you will, to be able to participate in these deals that you believe in? And so that's one. And then two, on the debt side, you still have the same type of requirements to make an investment, but that's someone who wants a simple cash on cash return every year.
Yep. Just coupon clipping, right?
You got it.
Now, before we wrap up, what does your investment portfolio look like, and why have you prescribed that specific diversification model for your own investments?
Ooh. So I would say I am I would say over leveraged. I'm over indexing in private companies.
Okay.
Well, why? The majority of my life, if you think about when I started this journey as the accidental entrepreneur, right back in 2010, I used to have a job. I was in finance, came out to California, company goes under. I'm marooned in Newport Beach, not a bad place to be.
Yeah.
Economics were really different from coming from Williamsburg, Virginia, where I went to college at the College of William and Mary. But out here going, okay. And I figured it out and built some companies and was lucky enough to sell them. But if you look at kind of my balance sheet, if you will, my personal balance sheet, it is a lot in private companies. Okay. Sure, I have investment accounts for retirement and 401ks and stuff that I used to have. And because I've owned businesses, I have self-elected pensions and all these different things. And those are great for retirement, don't get me wrong. But if you looked at where the majority of that is, it's in private companies or even in the ownership I have at Slyco that long-term believe will pay dividends. So why is it set up that way? Well, I've always invested either in myself, right, or in deals that I really understood how I could drive. And so that is comfortable for my wife and I and our family, right? As I continue, let's just say years go by, I think there'll be more real estate in the portfolio. I think it's a really smart play for many reasons. Capital markets exposure, other than what's happened over the last 4 days, is always and has proven to be a great return. So yeah, it's finding and making specific small bets while also building for your own retirement. And I think real estate, traditional capital markets, then of course, venture and private equity deals where you can be a little more risky, but take a flyer on can give you great returns as well.
Chris, appreciate you coming on the show today. For those that want to reach out to you or learn more about Slyco Capital, what's the best place for them to do that?
Yeah, so slycocapital.com is the site. My email is cvandusen@slycocapital.com. Also, LinkedIn, Chris M. Van Dusen, and Instagram the same, Chris M. Van Dusen.